If you're wondering, is $1 million enough to retire today or maybe even this year, then you'll want to watch this video, as I'll be talking about how far $1 million can go and whether or not you might need more than $1 million to retire. Welcome back. This is episode 272. I get asked by clients frequently, is $1 million enough to retire? So in this episode, I'll be delving further into how far $1 million can go, as well as talking about a process that I use with clients that you can use yourself as far as determining how much money you absolutely need to retire. But before I get into that, if you're 50 and older and you want to learn more about planning the ideal retirement, then consider signing up for my on-demand retirement readiness course. It's called Retirement Readiness On Demand. And it has over 7 hours of material that you can go through at your own pace to help you plan for your ideal retirement. We cover investments, Social Security, Medicare, taxes, estate planning, retirement income, and much more. The best part is that you have this material to go through at your own pace, as well as the course comes with some helpful checklists to prepare for retirement and put together your own financial plan. So to learn more, head over to retirewithryan.com and click on courses and click on demand. So you've probably seen it. I know I've seen it. Is $1 million enough to retire? I get asked frequently by clients that very question. So first of all, how far can $1 million go? Well, there's different methods as far as when you have a retirement nest egg, $1 million, for example, as far as how much of that $1 million can you actually draw off of in retirement. And the one general way to do that is by using what's known as a dynamic withdrawal strategy, where you're withdrawing a certain percentage of that money. So let's just say $1 million. There's different ideas as far as how much of that you could withdraw to generate an income off of. But if we use some methodologies, you say 5% of $1 million is how much you could start withdrawing on day one of retirement. Other methodologies say 3%. So let's say we use a middle of the road number. We use 4% as the number that you could start withdrawing from $1 million portfolio if you're the typical retiree, somebody retiring at age 65. So that's $40,000 per year. Now, for most people retiring with $1 million, chances are that most of that money is pre-tax money, which means that you're also going to need to pay some type of tax on that income. Anytime you're taking income from a retirement portfolio, an IRA, a 401k, if that was all pre-tax money that you did not pay tax on when you put the money into the plan, or your employer didn't pay tax on that money, then it's going to need to come out and be taxed. Now, unfortunately, retirement income, or I should say distributions from retirement accounts, are taxed as ordinary income, which means that you're probably going to pay at least 10% tax, possibly 12% federal tax, and if your income is a little higher, it could be into the next tax bracket of 22%. So you're going to be paying somewhere between 10 and 22% of income, possibly even higher, because there are higher brackets than that, of federal tax on that income. Also, if you live in a state that has state income tax, that income may also be subject to state income tax. So just be aware that that $40,000 that you could theoretically take out of your $1 million is not going to be tax-free. Now, if you're somebody who has converted all of your money to Roth IRAs or Roth 401ks years ago and you already paid the tax years ago, then that income could be tax-free. But if you're in that type of situation, you're really in the minority, because most people that have 401k assets they've been saving for 30, 40 years, most of that money is on a pre-tax basis, meaning it's going to be taxable when you take it out in retirement. So you have to factor in some type of federal and state income tax. So just to keep that in mind. So for most people, chances are, unless you have very low expenses, $40,000 before tax, let's just assume 15% tax between state and federal tax on that money, then you're going to be netting, you're going to be giving up $6,000 in taxes on that money, so you're going to be netting $34,000. Most people could probably not retire on $34,000 a year. But the good news is that if you've been living in the United States, if you've been paying into Social Security, or your spouse has been paying into Social Security, then you're going to get some type of Social Security benefit. So let's just say that was another $30,000 a year of Social Security. Now that $40,000 from your retirement nest egg plus $30,000 of Social Security, less some taxes, could be enough for you to retire on. So that $1 million could be the number for you. But again, just saying you need $1 million, maybe you've even seen that, because I had another client ask me this, is it now $2 million that I need to save up for retirement? And that could be the case, but it all depends on your needed income in retirement. So I've kind of gone a little bit ahead, but the process that I take clients through anytime someone is trying to figure out, do they have enough to retire, is step one, determining what your household expenses are. The easiest way to do that is by putting together some type of a monthly budget as far as what you are spending money on now and what you plan to spend money on in retirement. And this is a helpful worksheet that I provide to clients and prospective clients, and I'll put a link in it below. And it's basically just a spreadsheet that I've created in Excel that lists out what some of your likely expenses are in retirement. If you have a mortgage, if you have rent, if you have taxes, insurance, medical bills, then any utility bills that you have, food, travel, gasoline, vacations, right? Listing out what all of your expenses are. So once you've done that, you have a number, and you know step one, what is your retirement income need? And this, again, is on an after-tax basis. So if it's $50,000 a year of expenses that you have, and you really don't have a lot of wiggle room in there, then that's what you're going to need to retire. So then you could look to see, step two would be, what are your other retirement income sources? So I mentioned one of them earlier, Social Security. What do your Social Security benefits look like? What is your Social Security that you're eligible for, let's say at 65, or maybe even at 66 or 67 if you're going to work a little bit longer, so that you know what those benefits look like. If you haven't looked at your Social Security statement in a while, they are mailed to you, but maybe you're not getting them. Maybe you need to log in online. If you go to ssa.gov, you can log in and look at your statement. So that's step two, looking at your Social Security. If you're eligible for a pension, this could also be a part of that. So let's just say you're eligible for a pension, and your pension is going to be, $1,000 a month. Then you'd want to know, how much will that pension be? Pensions are also taxable, unfortunately. So just go under the assumption that most of your retirement income is going to be subject to some type of tax. So that you're going through looking at, okay, what am I going to get from Social Security? If I'm eligible for pension, what is that going to look like? And then the last step would be looking at that retirement nest egg. So if you do have $1 million saved up, as we talked about earlier, possibly you could take out 4% a year from that $1 million. And why do I say possibly? Because everyone has a different risk tolerance. So any of these withdrawal strategies that advocate you could take out 3%, 4%, 5% are assuming that you're going to get some type of growth on this money over your retirement. It's not just going to be left in the bank earning, very little interest. It has to be invested. And depending on your risk tolerance, if you're someone who's more comfortable with volatility in your portfolio, you really believe in the stock market, you're confident owning stocks, then you could have more of your retirement nest egg allocated towards stocks, somewhere probably between 50 to 70%. And that's going to allow you to take out a greater withdrawal percentage over time, theoretically, than somebody who's more conservative and wants to have more money in bonds and cash, because you're very concerned with market volatility. If that's the case, then your portfolio is probably going to generate a lower return over time, because the return on stocks in general is higher than bonds and cash over the long term. Depending on the time frame that you look at, stocks have averaged anywhere from a 7% to an 11% rate of return over 10-year, 15-year, 20-year periods. Those are the types of periods that you need to be looking at, because that's what your theoretically retirement is going to be. When you add bonds and cash in there, bonds and cash are dependent upon interest rates. And though recently we've seen interest rates come way up, and it's been very helpful for bond investors and conservative investors because you're getting a higher interest rate now on your cash. You're getting a higher interest rate on your cash if you move it into money market. You're getting a higher interest rate on a CD, on bonds than 2-3 years ago when you were getting almost 0%. But that return is always going to be dependent upon interest rates. So if interest rates go way down, then your return on those investments is going to be lower, and therefore your withdrawals over time could potentially be lower. So that's where you have to do some homework to figure out what asset allocation is right with you and what are you comfortable with. Another thing to think about too is that how far your money is going to go depends upon where you live. And certain areas of the country, like I'm in the Northeast, I'm in Connecticut, are more expensive historically than the southeastern part of the United States. The Midwest might be less expensive than the West. So you have to kind of think about what can you do potentially to lower some of your expenses. Downsizing is something you can do. Sometimes it's getting harder because real estate prices are really high and taxes have been going up really everywhere as far as property tax, but maybe you can downsize. And maybe just moving to another place, your money will go even farther. So that could allow you maybe some more flexibility within your retirement income to lower some of your expenses or even eliminate some expenses by doing it. But as far as gauging how far that $1 million will go, that 3 to 5% withdrawal rate is really the maximum that you can be spending. If you start spending 6, 7, 8% or more, you're going to run out of money sooner than you want. It's just a mathematical certainty. Knowing that what historical rates of return have been, if you're taking out 8% of your portfolio, your money is not going to last as long as you need it to, which is probably the typical 20 to 30 year retirement. And that's what these rates of withdrawal are based on. These rates of withdrawal, taking out a dynamic withdrawal rate, are based on past market returns and adjusting for inflation so that your income can keep pace with inflation over time. So that if you start taking out 4% today, hopefully over time you can raise that 4% so that it's keeping up with inflation. You don't want to be on a fixed income in retirement where you're just taking out 4% that looks great right now, $40,000, but in 10 years, $40,000 is not going to buy the same amount of goods that it's buying today. You're going to be losing purchasing power. So that's where adding something that gives you a hedge against inflation, which really historically has been owning stocks, owning stock funds, stock mutual funds, has given you the best hedge against inflation because their ability to increase over time. And stocks are doing that because just like any company, if inflation's going up and the cost of things are costing more in the future, companies are passing that on to the consumer. Therefore, they're raising their prices, they're raising their fees, and that's theoretically going to raise their stock price as well. So that's why stocks have the ability to do that. Whereas if you bought a 10-year bond right now paying you, let's say 4%, you're locked in for 10 years. You can't buy a new bond if you're going to hold it the full length of time until 10 years from now. So that 4% rate might look good now, but if inflation keeps going higher and higher, which it always does, that 4% isn't going to look as good. So that's why it's important to think about how you're designing your portfolio. Additionally, a financial advisor can be a big help in helping you figure out, do you have enough to retire? You can always reach out to me and my team if you need help. And I've also started another website for fee-only financial advisors, where if you want to find another fee-only financial advisor that is truly fee-only, meaning that they don't accept any commissions, they're just licensed as a registered investment advisor, you can check out findmyfiduciary.com. It's another website that I've created where other fee-only financial advisors are listed. They've gone through a little bit of a background check, and we've confirmed they're fee-only advisors. And we've also made sure that they adhere to the fiduciary oath, which is extremely important to always put the client's interest ahead of their own. So head over to findmyfiduciary.com if you want to find another financial advisor that can help. So I hope this episode was helpful. And as always, if you have a listener question, head over to retirewithryan.com and click on Ask a Question. Take care.